Bismillahirrahmanirrahim. In this video, we will discuss cases related to why people commit fraud. The first case is related to detecting and preventing fraud in the office, where we will discuss strategies for maintaining integrity and accountability in the office. The second case explains the pressures, opportunities, and rationalizations of committing fraud. The third case study is on understanding organizational factors and rationalizations to commit fraud. The fourth case explores how trust and accountability play significant roles in investment fraud. And finally, the fifth case is on fraud involving petty cash mismanagement and discusses preventive measures. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. So let us look into the first case uh, that is related to detecting and preventing fraud in the office. And in this case, we will discuss strategies for maintaining integrity and accountability in the office. So, Green Grass is a small family operated company whose core services is in horticultural care and lawn care for customers in the local city. The owner of the company is the father of the family. He has used the company to cover the cost of his children's college education. At the same time, he has been able to give his children some work experience and an opportunity to earn their own money to pay for school. The company has grown steadily over the last few years, and the owner has hired many employees outside of the family to be able to keep up with the demand of the increasing number of customers. The company is run from a small building, and there is only one employee running the operations in the company office. The father has usually been in charge of this aspect of the company, but now leaves the responsibility to his trusted friend who has experience in accounting and information systems. This employee is in charge of scheduling the routes of all the employees and is responsible for payments, receipts, and balancing the books. The company performs two major operations. First, it provides lawn care using insecticides, fertilizer, and weed killers. 8 employees are responsible for this activity. They each drive a truck and are responsible for collecting money from the customers they serve. They are also responsible for loading and mixing chemicals in the tanks they use during the day. The second part of the operation is the lawn mowing care. Usually, a 4-man crew is responsible for all the machines they use, and they are responsible for taking care of the lawns on their daily schedule. This is where the owner has hired his children to work, and the whole team is used, made up of younger workers than the team that works with the chemicals. Over the years, green grass has experienced small growth and success. Profits have increased steadily as the company has picked up new clients. However, the owner noticed that last year's accounts were different. The revenues increased a marginal amount, while the expenses for the month increased more than they should have. The owner has noticed that his interactions with his friend in the office have been fewer. Also, his employees have been finishing their routes later in the day than they had in the previous years. So let us look into the questions, and the first one is, what are some of the fraud opportunities with green grass? So some of the fraud opportunities with green grass is number one, the limited oversight. Uh, as you can see over here, the owner has reduced his interactions with the employee in charge of operations in the company office. This may create opportunities for fraud, as there is less supervision and oversight over financial activities. Second, there is lack of segregation of duties. Uh, as you can see, that having just one employee responsible for scheduling routes, handling payments, receipts, and balancing the books increases the risk of fraud, as there is no segregation of duties to ensure checks and balances. The third is cash handling. As you can see, employees are responsible for lawn care, including collecting money from customers, loading and mixing chemicals, have opportunities to manipulate cash transactions and misappropriate funds. Yet another may be the expense manipulation, the increased expenses relative to uh, you can see over here the increased expenses relative to revenue could indicate potential expense manipulation or mismanagement, especially if there are insufficient controls in place to monitor and track expenses. Then late completion of routes, that is employees finishing their routes later in the day than usual, could indicate inefficiencies or potential misconduct, such as extending work hours to falsify billable hours or engaging in unauthorized activities. So, addressing these fraud opportunities require implementing robust internal controls, such as enhancing oversight, segregating duties, implementing stringent cash handling procedures, closely monitoring expenses, and ensuring timely completion of tasks. Let us look into the second question. What symptoms of fraud exist, and what symptoms should the owner look for if he believes fraud may be occurring? So, some symptoms of potential fraud and additional signs the owner should look for if he suspect fraud may be occurring at green grass. They may be like discrepancies in the financial records. Uh, as you can see, the increased expenses compared to revenues, as noticed by the owner, could indicate potential financial irregularities or mismanagement. Then decreased owner environment uh, has decreased owner involvement, as you can see over here. So reduced interactions between the owner and his friend in the office may suggest a lack of transparency or communication regarding company finances. Then changes in employees' behavior. Employees finishing their routes later than usual may indicate potential inefficiencies or misconduct, such as extending work hours to falsify billable hours or engaging in unauthorized activities. Then, unusual tax and transactions like unexplained fluctuations in cash flow, such as large or frequent withdrawals, deposits, or transfers, could be indicative of fraudulent activity such as embezzlement or skimming. Uh, Missing or incomplete documentation related to expenses, payments, or receipts may signal potential attempts to conceal fraudulent activities. Employee complaints or whistleblowing, like complaints from employees about irregularities in financial processes or suspicions of fraudulent behavior, should not be dismissed and should be investigated promptly. Sudden or unexplained changes in the lifestyle of employees or the owner, such as purchasing luxury items beyond their means, could indicate potential misappropriation of company funds. Then, significant fluctuation in financial performance, such as sudden drops in profitability despite increasing revenue, may warrant further investigation into potential fraud or financial mismanagement. The owner should remain vigilant and proactive in monitoring the company's financial activities, regularly reviewing financial records, maintaining open communication with employees, implementing internal controls, and promptly investigating any suspicions or red flags of fraudulent behavior. So let us move on to the third one. What steps should be taken to make sure fraud does not occur, and what are the costs associated with these steps? So to prevent the fraud and mitigate risk at green grass, we can take interesting steps like implement internal control, like establish robust internal control procedures for financial transactions, such as segregation of duties, regular reconciliations, and oversight of financial activities by multiple individuals. This may involve hiring additional staff or assigning responsibilities to existing employees, incurring costs associated with salaries or training. Then conduct regular audits, perform regular internal audits to review financial records, operational processes, and compliance with company policies and regulations. This may involve hiring external auditors or investing in audit software, incurring costs associated with audit fees or software licenses. Then enhance supervision and monitoring, increase oversight and monitoring of employees' activities, particularly those handling financial transactions or sensitive information. This may involve investing in surveillance systems, time tracking software, or additional managerial oversight, incurring costs associated with technology purchases or personal expenses. Then implement fraud prevention policies, like develop and enforce clear policies and procedures for detecting, reporting, and addressing potential fraud or misconduct. This may involve investing in fraud detecting software, employee training programs, or legal consultation, incurring costs associated with software licenses, training sessions, or legal fees. Then improve communication and transparency, that is, foster open communication channels between management and employees, encouraging reporting of suspicious activities or concerns. This may involve investing in whistleblower hotlines, employee feedback mechanisms, or regular staff meetings, incurring costs associated with communication tools or administrative support. Then conduct background checks, perform thorough background checks on employees, contractors, and vendors to verify their credentials and identify any past instances of fraud or misconduct. This may involve hiring third party background screening services, incurring costs associated with background checks, fees, or subscription services. So, while implementing these steps can help prevent fraud and protect the company's assets, it is essential to consider the associated cost and weigh them against the potential benefits of fraud prevention. The cost may vary depending on the size and complexity of the organization, but investing in effective fraud prevention measures is crucial for safeguarding the company's reputation, financial stability, and long term success. Uh, Let us move on to the second case, and this case explains the pressures, opportunities, and rationalizations of committing fraud. So, James Watkins, an ambitious 22-year-old, started an entertainment business called Best Club after he graduated from California State University. Best Club initially was the business failure because James ignored day to day operations and cost controls. 1 year later, James was heavily in debt. Despite his debt, James decided to open another location of Best Club. He was confident that Best Club would bring him financial success. However, as his expenses increased, James could not meet his debts. He turned to insurance fraud to save his business. He would stage a break in at a Best Club location and then claim a loss. In addition, he reported fictitious equipments to secure loans, falsified work order contracts to secure loans, stole money orders for cash, and added zeros to customer bills who paid with credit cards. James was living the good life with an expensive house and a new sports car. 2 years later, James decided to make Best Club a public corporation. He falsified financial statements to greatly improve the reported financial position of Best Club. In order to avoid the SEC's security of his financial statements, scrutiny of his financial statements, he merged Best Club with Red House, an inactive New York computer firm, and acquired Red House's publicly owned shares in exchange for stock in the newly formed corporation. The firm became known as Red House and the Best Club name was dropped. James personally received 79% of the shares. He was now worth 24 million on paper. James was continually raising money from new investors to pay off debts. A few months later, Red House's stock was selling for 21 a share and the company's book value was 310 million. James was worth 190 million on paper. A short term later, a short time later, he met John Gagn, a president of AM firm and advertising service. Gagn agreed to raise 100 million via junk bonds for Red House to buy out Sun Society, a travel service. Afterward, with the television appearances, James became a hot figure and developed a reputation as an entrepreneurial genius. However, this reputation changed after an investigative report was published in a major newspaper. The report chronicled some of his early credit card frauds. Within 2 weeks, Red House stock plummeted from 21 to 5. After an investigation, James was charged with insurance, bank, stock, and mail fraud, money laundering, and tax evasion, and Red House's shares were selling for just pennies. A company once supposedly worth hundreds of millions of dollars dropped in value to only 48,000. So, from this case, we have to identify number one, the pressures, opportunities, and rationalizations that led James to commit his fraud. So, the pressures that led James to commit fraud now was number one was the heavy debt. James was heavily in debt due to the failure of his initial business venture, Best Club. Then the second pressure was desire for desire for financial success. Despite being in debt, James believed that expanding Best Club would bring him financial success and alleviate his debt burden. So these may be the two pressures that force him to commit fraud. Then the opportunities that led James to commit fraud was number one, financial distress. That is, uh, you can see over here that James' dire financial situation created opportunities for fraudulent activities as he sought ways to save his failing business and maintain his lifestyle. Then a lack of oversight. You can see that James' control over the operation of Best Club, including financial management and reporting, provided him with opportunities to engage in fraudulent activities without detection. Then the rationalizations were number first of all, it was justification for fraud to save business. That is, James rationalized his fraudulent actions, such as there was insurance fraud, then uh, then falsifying financial statements as necessary steps to save Best Club and achieve financial success. Then perception of invincibility, as we have seen that as James experienced initial success with his fraudulent activities and gained wealth and recognition, he may have rationalized his actions as justified by his entrepreneurial genius and perceived immunity from consequences. So, overall, James' fraud was driven by financial pressures, facilitated by opportunities arising from his control over Best Club, and rationalized by his belief that his actions were necessary for the success of his business and justified by his perceived entrepreneurial talent. So, let us move on to the second one, the signs that could signal a possible fraud. So the first one was the sudden increase in the expenses. James has experienced a significant increase in expenses as his business expanded, leading to financial distress and an inability to meet debt. Then, unusual financial transactions, that is, James engaged in various fraudulent activities, including insurance fraud, falsifying financial statements, reporting fictitious equipments to secure loans, and stealing money orders for cash. Then, life. 1 minute. Then lifestyle incongruence, that is, despite being heavily in debt, James was living a lavish lifestyle with an expensive house and a new sports car, which could raise suspicions about the source of his wealth. Then falsified irregularities like falsified financial statements, uh, and misleading reports of Best Club financial position. Uh, um, best these were the indicators of potential fraud. Then securities manipulation. James has manipulated financial statements to artificially inflate the value of Red House stock, which could signal fraudulent activities to investors and regulators. Then, negative media coverage. Investigative reports exposing James' fraudulent activities and criminal history led to a rapid decline in Red House stock value, indicating underlying fraudulent practices. So, overall, these signs of financial irregularities, lifestyle incongruence, and negative media coverage could serve as red flags indicating potential fraud within James Watkins' business operations. Then, controls or actions that could have detected James' behavior. Uh, so, one may be improved oversight and internal control, that is implementing stricter oversight and controls over day-to-day operations and financial transactions could have prevented James from engaging in fraudulent activities such as falsifying work order contract, stealing money orders, and adding zeros to customer bills. Then, second, it may be enhanced financial reporting and auditing, that is, conducting regular financial audits and reviews of best clubs' financial statements could have detected discrepancies and inconsistencies, uncovering James' falsification of financial statements to improve the reported financial position of the company. Then, due diligence in merger and acquisition, conducting thorough due diligence before merging Best Club with Red House could have uncovered James' fraudulent activities and misrepresented financial statements, preventing the fraudulent acquisition of Red House's publicly owned shares. Then regulatory scrutiny and compliance, enhance regulatory scrutiny and compliance measures such as oversight by the Securities and Exchange Commission could have detected James securities fraud and prevented the fraudulent manipulation of Red House stock value. Then whistleblower mechanism, to encourage and protect whistleblowers within the organization could have prompted early detection and reporting of James' fraudulent behavior by employees or stakeholders aware of the fraudulent activities. So, overall, implementing these controls and actions could have increased transparency, accountability, and oversight within Best Club and Red House, facilitating the early detection and prevention of James' fraudulent behavior. Let us look into the third case. And this case study is on understanding organizational factors and rationalizations to commit fraud. So, Johnson Manufacturing, a diversified manufacturer, has 7 divisions that operate in the United States, Mexico, and Canada. Johnson Manufacturing has historically allowed its division to operate independently. Corporate interventions occur only when planned results are not obtained. Corporate management has high integrity, although the board of directors is not very active. Johnson has a policy of performing employee screenings on all employees before hiring them. Johnson feels its employees are all well educated and honest. The company has a code of conduct, but there is little monitoring of employees. Employees' compensation is highly dependent on the performance of the company. During the past year, a new competitor has entered one of Johnson's highly successful markets. The new competitor has undercut Johnson prices. Johnson managers of this unit, Harris, has responded by matching price cuts in hopes of maintaining market shares. Harris is very concerned because she cannot see any other area where cost can be reduced so that the division's growth and profitability can be maintained. If profitability is not maintained, the division manager's salaries and bonuses will be reduced. Harris has decided that one way to make the division appear more profitable is to overstate inventory. Since it represents a large amount of the division's balance sheet, She also knows that controls over inventory are weak. She views this overstatement as a short run solution to the profit decline due to the competitor's price cutting. The manager is certain that once the competitor stops cutting price or goes bankrupt, the misstatements in inventory can be corrected with little impact on the bottom line. So, what factors in Johnson's control environment has led to and facilitated the manager's manipulation of inventory? So we can see that there are several factors in Johnson manufacturing control environment have contributed to and facilitated uh, the manager's manipulation of inventory, like there is lack of active board directors. The board of directors is not very active, suggesting limited oversight and accountability and at the corporate level. This lack of oversight creates an environment where managers may feel less accountable for their actions. Then, second, maybe the divisional autonomy. Historically, Johnson Manufacturing has allowed its divisions to operate independently with corporate intervention only occurring when planned results are not obtained. This decentralized structure may lead to weaker controls and monitoring at the division level, allowing managers like Harris to exploit vulnerabilities. Then another was a limited monitoring of the employees. That is, despite having a code of conduct in place, there is little monitoring of employees. This lack of oversight provides an opportunity for unethical behavior to go undetected, as seen in Harris' manipulation of inventory. Then the compensation structure. Employee compensation is highly dependent on the performance of the company, including divisional profitability. This creates pressure on managers like Harris to maintain or enhance profitability, even if it means resorting to fraudulent activities such as overstating inventory. Then, weak inventory control. Harris recognizes that controls over inventory are weak within the division. This lack of robust controls makes it easier for her to manipulate inventory figures without detection. Overall, the combination of limited oversight, decentralized decision making, pressure to maintain profitability, and weak controls over inventory creates an environment conducive to manipulation and fraud by managers like Harris. Then let us move on to the second question. What pressures did Harris have to overstate inventory? So, we have seen that employee compensation is dependent on the performance of the unit. If the division doesn't do well, salaries and bonus will be cut. So Harris faced several pressures that led her to overstate inventory. Like number one was the competitive pressure. Uh, The entry of the new competitor into Johnson's highly successful market posed a significant threat to the division's profitability. The competitor undercut market posed a significant threat to the competitors undercut Johnson's prices, leading to a decline in market share and potential loss of customers. Harris felt pressure to respond to this competitive threat by maintaining market share, which required demonstrating profitability despite the profit cuts. Then a performance linked compensation. Uh, Harris' compensation, including her salary and bonuses, was highly dependent on the division's performance. If profitability was not maintained, her compensation would be reduced. This financial pressure incentivized Harris to take actions to boost the division's apparent profitability in the short term, even if they were unethical and or unsustainable. Then another was perception of limited options. Harris has viewed overstating inventory as a short term solution. Harris has perceived that there were no other viable options to reduce cost or increase profitability within the division. So, this perception may have stemmed from a lack of creativity or strategic thinking, as well as a belief that the competitors' price cuts left no room for other competitive responses. Then, another may be the short term focus. That is, Harris has viewed overstating inventory as a short term solution to the profit decline caused by the competitors' price cutting. She likely prioritized immediate results and did not consider the long term consequences of her actions, such as the potential for damage to the company's reputation or financial health. So, overall, the combination of competitive pressure, financial incentives, perceived limited options, and a short term focus created significant pressures for Harris to overstate inventory as a means of addressing the division's declining profitability. Okay. Let us move on to the third question. What rationalizations did Harris use to justify her fraud? So she used several rationalizations to justify her fraud. The first one was the short term solution. This is the first one you can see. That is, Harris rationalizes that overstating inventory was a short term solution to the profit decline caused by the competitors' price cutting. She believed that by inflating inventory temporarily, she could create the appearance of profitability and maintain market share until the competitor's pricing strategy changed or the competitor went bankrupt. Then a perceived lack of options. You can see the perceived lack of options. She may have rationalized her actions by convincing herself that there were no other viable options to address the division's declining profitability. She may have believed that cutting costs or finding alternative revenue streams were not feasible, leaving her with no choice but to manipulate inventory figures to meet performance targets. Then, lack of impact on bottom line. Harris has likely rationalized that the misstatements in the inventory would have little impact on the division's bottom line once the competitor's price cutting ceased. She may have believed that any corrections to the inventory figures could be made without significant consequences, allowing the division to maintain its profitability in the long run. So, overall, Harris used rationalizations to justify her fraudulent actions by portraying them as necessary measures to address immediate challenges and maintain the division's financial performance in the face of external pressures. Okay. Now, trust is essential in investment relationships, but it must be accompanied by accountability to prevent fraud. Investors should prioritize transparency and due diligence to mitigate the risk of falling victims to investment fraud. This case explores how trust and accountability play significant roles in investment fraud. Now, the following describes an actual investment fraud that occurred. Mr. Armstrong stands accused in a federal indictment for committing one of the most common frauds in the history of finance, making big promises to investors that he couldn't deliver. Mr. Armstrong is accused of securities fraud after allegedly trying to cover up millions of dollars in bets on the yen and other markets that went horribly wrong. It is probably not the ending that the 49-year-old Mr. Armstrong envisioned when he fell in love with business as a boy. It was a love that turned him into an active stamp dealer at just 13 years old, only to be kicked out of the stamp world's most elite fraternity as a young man in 1972 amid accusations of selling extremely rare stamps that he didn't own and couldn't deliver. Undaunted, he fought back and became a stamp authority and eventually an authority on the far more sophisticated financial markets on which he was widely quoted. His self confident forecasting style made him a hit in Japan, where Mr. Armstrong is now accused of bilking investors out of 950 million. Documents he used to sell his investment show that he promised buyers of his securities that a yield of 4% was guaranteed on the fixed instrument, a strong selling point in a country where interest rate on government bonds are less than half that. Moreover, the securities were designed to offer further returns on as high as 25% depending on market conditions. Mr. Armstrong's bets on the markets increasingly began turning against him. The Securities and Exchange Commission says that from late 1997, Mr. Armstrong began to rack up increasingly big losses on large investments he made in currencies and options. Between November 1997 and August 1999, for example, SEC officials say Mr. Armstrong lost 295 million in trading the yen alone, all money that belonged to clients. In the wake of the discovery of the fraud, the SEC said in its civil complaint that was filed, Armstrong has transferred millions of dollars from Princeton global accounts into foreign banks accounts he controls. SEC officials declined to disclose how much money Mr. Armstrong allegedly transferred overseas or to what countries. On two previous instances, Mr. Armstrong did face commodities trading scrutiny. In 1985, the agency overseeing commodities trading in the United States lodged a complaint against him for allegedly not registering and maintaining proper investment records. Then in June 1987, the same agency fined Mr. Armstrong $10,000 and suspended him from his trading privileges for a year for improper risk disclosure and misrepresentation of his trading returns. Part of the complaint was related to advertising in a Princeton newsletter. So the first question is, how did trust contribute to Mr. Armstrong's fraud? So you can see that the trust has played a significant role in Mr. Armstrong's fraud and in several ways. Like first one was the trusted reputation. Mr. Armstrong has built a trusted reputation over the years, starting from his early involvement in stamp dealing to becoming an authority in financial markets. Investors trusted him based on his perceived expertise and credibility in the industry. Then guarantees and promises. Mr. Armstrong exploited the trust placed in him by making big promises to investors, such as guaranteed yield of 4% on fixed rate and potential return of as high as 25% based on market conditions. So these promises appealed to investors seeking reliable returns and were instrumental in convincing them to invest their money with him. Sorry. Then self-confident forecasting style. Mr. Armstrong's self confident forecasting style further contributed to the trust investors placed in him. His ability to articulate market predictions and present himself as an authority figure made him appealing to investors who were more likely to believe in his investment strategies and follow his recommendations. Despite previous instances of regulatory scrutiny, Mr. Armstrong's track record and continued presence in the financial industry likely reassured investors about his reliability and competence. They may have viewed his past successes as evidence of his ability to deliver positive returns, further enhancing their trust in him. So, overall, trust played a crucial role in Mr. Armstrong's ability to defraud investors as it facilitated their willingness to invest significant sums of money based on his promises and perceived expertise in the financial markets. Let us look into the second one. In the chapter, lack of access to information was discussed as one of the factors that provide opportunities for fraud. If investors have known Mr. Armstrong's background and has access to other information about him, how would it have affected the fraud and why? So, if investors had known Mr. Arm's background and has access to other information about him, it would have potentially prevented or mitigated the extent of the fraud in several ways, like awareness of past conduct, that is, the knowledge of Mr. Armstrong's past conduct in the stamp dealing industry. Um, Let me clean up. Uh, Knowledge of Mr. Armstrong's past misconduct in the stamp dealing industry, including accusation of selling rare stamps he didn't own, could have raised red flags for investors. This awareness might have led them to conduct more thorough due diligence before entrusting their money to him, potentially uncovering inconsistencies or warning signs. Then the regulatory scrutiny. Investors would have been aware of Mr. Armstrong's history of regulatory scrutiny and previous fines related to improper risk disclosure and misrepresentation of trading returns. Now, this knowledge could have made them more cautious about investing with him, prompting them to seek additional assurances or clarifications on his investment strategies and practices. Then, evaluation of reputation. Investors might have reconsidered their trust in Mr. Armstrong's self proclaimed expertise and authority in financial markets if they have known about his past controversies and regulatory violations. They could have been more skeptical of his promises and guarantees, leading to increased scrutiny of his investment proposals and a reluctance to invest significant sums of money without more transparency and accountability. Then, risk assessment, that is, access to information about Mr. Armstrong's previous failures and losses in currency options. Uh, uh, So, the losses in currencies and options trading could have provided investors with valuable insight into the risk associated with his investment strategies. So, armed with this knowledge, investors might have made more cautious about may have been more cautious about entrusting their funds to him, especially if they perceived his trading activities as overly speculative or high risk. So, overall, greater transparency and access to information about Mr. Armstrong's background and past behavior could have empowered investors to make more informed decisions and potentially avoid falling victims to his fraudulent schemes. It would have enabled them to assess the risk more accurately and question the legitimacy of his investment offerings, thereby reducing the likelihood of financial losses resulting from his fraudulent activities. So, this completes the discussion of case number 4, and we move on to the next case. Uh, but I intended to pay it all back. I really did. Joseph Swanky said as he talked to his manager. How did I ever get into this situation? He thought. Now, 2 years ago, Joe received the promotion he has been working for so long. His new manager told him that he had a promising future. Joe and his wife quickly purchased a new home. Not longer after, Joe and his wife Jane had their 4 children, and life was great. After having their fourth child, Janie quit the work to spend more time with her kids. Suddenly, things started to turn upside down. The economy took a downturn and had a negative impact on Joe's company. His pay, which was based on commission, was reduced nearly 50%. Joe still worked hard but thought he should be paid more. Unable to find another job, Joe resentfully decided he would stay with the company even with the lower pay. Not long after he started receiving lower commissions, Joe noticed the controls over the petty cash funds weren't strong, the records were not reviewed very often, and small shortages were usually written off. One week, Joe took $50. When questioned by his wife, Joe said he has found a few odd jobs after work. Joe continued this habit of taking small amounts for a couple of weeks. After realizing that no one had noticed the shortage, he started to take up to 100 a week. One day, another employee noticed Joe taking some cash from the fund and putting it in his wallet. When questioned, he simply stated that it was a reimbursement the company owed him for supplies. An investigation began and Joe fraud was discovered. So, uh, we have to identify the opportunities, pressures, and rationalizations that led to commit this fraud. So, first of all, let us look into the opportunities, and the first one is the weak controls. Joe has noticed that the control over the petty cash fund were not very strong, with records not being reviewed frequently and small shortages being written off. So, this created an opportunity for Joe to exploit the lack of oversight and take money from the fund without immediate detection. Then, the pressure obviously is the financial constraint or the financial strain. Joe has experienced a significant reduction in his pay. You can see nearly 50% due to the economic downturn impacting his company. With a growing family and his wife quitting her job to spend more time with the children, Joe likely felt financial pressure to maintain their lifestyle and cover expenses, especially with the added responsibility of a new home and 4 children. So this was the pressure. And so let us look into the third one, that is rationalizations. So the first rationalization was the intention to pay back. So Joe rationalized his action by convincing himself that he intended to pay back the money he took from the petty cash fund. Despite knowing that his actions were fraudulent, Joe tried to justify his behavior by believing that he would eventually make enough money to reimburse the funds he had taken. Then resentment towards the company. Feeling undervalued and underpaid, Joe may have rationalized his fraudulent behavior as a form of compensation for the perceived injustice of his reduced pay. He may have justified stealing from the company as a way to reclaim what he felt he deserved but was not receiving through his salary. So, overall, the combination of weak controls over the petty cash fund, financial strain, and rationalizations regarding repayment and resentment towards the company contributed to Joe's decision to commit fraud. Let us look into the second question. What simple procedures could the company have implemented to prevent fraud from occurring? So, to prevent the fraud from occurring, the company could have implemented several simple procedures like strengthen the controls. The company should establish stronger controls over the petty cash fund, including regular reviews of records and strict policies for handling cash. Then segregation of duties. Implement segregation of duties by assigning different individuals to handle and review petty cash transactions. This separation of duties helps prevent unauthorized access and reduces the risk of fraud. Then mandatory reconciliation. Implement a mandatory reconciliation process for the petty cash fund on a regular basis, such as weekly or monthly. This ensures that any discrepancies or irregularities are promptly identified and investigated. Then receipt verification. Require employees to provide receipts for all petty cash expenditures. This helps verify the legitimacy of expenses and ensures that funds are used for authorized purposes. Then finally, oversight and monitoring, that is increase oversight and monitoring of petty cash transactions by management. This can include random audits, spot checks, and regular reviews of petty cash records to detect any anomalies or suspicious activities. So, by implementing these simple procedures, the company can strengthen its internal control and mitigate the risk of fraudulent activities like the one committed by Joe. So, we can see that petty cash fraud can be prevented through effective controls and accountability measures. Proactive steps such as designated custodians and regular reconciliations are essential for a for safeguarding the company assets. So this completes the third video on why people commit fraud. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, accounting is a K. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.